Good evening. Welcome to Money Matters. I'm Charlie Shields of Wells Fargo Advisors, member SIPC. My co-host is Patricia Dunn from Merrill Lynch. Pat, good to see you again tonight.
Good to see you.
And our special guest is Mark Blair, who's a certified financial planner from Blair Wealth Management. And Mark's going to talk to us, I think, a little bit about the markets and a little bit of the psychology of being invested. It's going to be a good show, so stick with us. Okay, Pat, let's start talking first about health care.
Big topic.
even though this show is being taped quite a bit before it's going to be aired, I think they'll still be talking about health care by the time everyone sees this on the show. And I guess the big question is, are we headed toward a single-payer health system?
Personally, I don't think so, but that's my opinion. You may have a different opinion. We have that in other countries. Certainly we have it with our own Congress. But I don't think it's going to fly here in the United States. I really don't.
Well, and I hope it doesn't. My take is that there's some number like 75 or 80% of the people in the United States that are able-bodied enough to be what I would call makers. People that are making something happen. And then there's 20% or so people that just need our help. And this is a great country, and I think we can do that if we've got 80% pulling on the oars. So I would hope that things like health savings accounts,
yes,
where a family of four is given some number like $20,000 or $24,000 a year, and that money can be used for other things if it's not used for health care. And when they go to see the doctor and he says, go get an MRI, because it's their money, they say, well, should I go to this one or that one, and how much do they cost? And they find out this one's $1,200 and this one's $700, and they're the same quality, because an MRI is pretty much an MRI if they know what they're doing. And so all of a sudden people know what they're paying.
Right.
So I'm hoping we can do that, and I think we could save enormous amounts of money. And I hear these stories about how we're going to be able to take this human genome stuff and we're going to figure out who's prone to have cancer early in life, and we can get to that and cure it. So I'm excited about the possibilities if we don't just saddle this all with the U.S. government and then have us with another system that just nobody's paying attention to costs. So that was my purpose in asking that question in the first place, to get on my little hobby horse there and make a speech. Let's talk about the DOL rules, Department of Labor. Now, the Department of Labor came out ahead of the SEC because they have to worry about this Pension Benefit Guaranty Corp, and that was their entree to say they were going to tell investment advisors how they should manage money within pension plans and IRAs. And now I understand the SEC is going to start getting involved over on the other side. So can you talk about that for a minute?
Well, it's very interesting because you and I have been in the industry a very long time, and it struck me as odd that it would be the Department of Labor first, but the reason is very good. And then the SEC, who controls non-retirement accounts, they started, as you say, making some noises. And you have to wonder, is there a bit of a turf war going on here? But I think the reality is, yes, the SEC will get involved, but it's going to take a little bit more time, because the SEC has come right out and said that they just don't have the staff right now to ensure compliance.
Yeah.
So it will happen, but I think that it's going to lead with retirement accounts first.
And it made no sense to me to say, well, people have to, the advisor has to do the right thing on the retirement plans, but never mind over there
on the personal side,
you
yes.
know. So let's hope everyone out there is fortunate enough to have someone who cares about all their accounts and is doing the right thing.
Exactly.
And speaking of doing the right thing, let's talk about costs. I saw a recent Wall Street Journal article where a reporter for the Wall Street Journal was trying to figure out what her all-in costs were. And she got kind of run around the track a few times trying to get it sorted out. Can you talk a little bit to our viewers and listeners about how they can sort this out?
Well, the industry's going to sort it out for them.
Okay.
I've been in the industry for over 40 years, and the industry, as you know, is not known for its clarity, and certainly not known for its clarity around costs. But as the industry evolves, we're going to have 4 levels of service, that is going to have 4 levels of transparency about what is the level of service you're receiving and what are you paying for that level of service. So I think the DOL actually has done quite a favor for investors of all sizes, from small to large. But quite simply, you're going to have do-it-yourself, which can vary from $6 a trade to zero, free. You're going to have robo-advisors, which I like to refer to as automated advice. And that's going to range up to about 0.45% in cost. And you can get into that for as little as $5,000. And then you can get into generic advice, where your first time you're going to deal with a human being. First two are with the computer. But with generic advice, you're actually dealing with a human. It will be subject to the fiduciary standard. Its cost is going to range a little bit more than 0.75, but understand it's actually going to be 0.85%. But understand they can only give you generic advice. But for the small investor, for as little as $20,000, they're going to have access to strategies with audited track records, and they're going to get annual portfolio reviews. When was the last time a $20,000 investor had an annual portfolio review? And then what you and I do, personalized service, which is more holistic in nature and, of course, more comprehensive and more expensive.
Sure. Okay. Well, that's an excellent answer. Thank you for helping people think about that. By the time we get to this show being aired, if the market keeps going up, it's going to be a little worrisome. Everyone will probably have turned bullish by that time. Are you a contrarian? Do you worry if the market's gone straight up for a long time and everybody has decided it's time to buy, that there's no buyers left?
I say when people are knocking on my door saying, I absolutely have to open up an account with you, it's time to start selling. That hasn't happened yet.
Right, and when they call me up and they say, what kind of booze do you drink, it's time to hit the sell button before I answer their question. But
exactly.
At any rate, so Sir John Templeton said bull markets will end when everyone is totally enthusiastic and excited and euphoric, and I don't sense that yet, but we'll keep an eye out for it. Okay, I want to hit a couple of things quickly so we can get to our special guest. Housing is sending out mixed signals, and I think a lot of our economy depends on housing. What's your forecast or outlook for what you think is going to go on in the housing market?
Well, it's very interesting right now because at the extreme high end, the $1 million plus properties, they're just not moving at all. The middle range, 400 to 600, they're moving pretty well. And at the lower end of the range, the first-time home buyers, they're still not out from being underwater. It's good that we have a segment of the market that is moving. And the other part of the housing industry that's really getting a plus are the mortgages. So many people are refinancing because they've reached a point where the interest-only mortgages have run their course. And now with rising interest rate, they realize it's time to get into a fixed mortgage. So we're seeing a lot of activity in the mortgage market.
Okay. How do you help your clients reach for income if they're afraid of U.S. government bonds having been driven down to very low interest rates compared to where they should be?
That's a really good question because the dividend-paying stocks have been run up so high with such high PE ratios. I've been urging people to stay away from the highest yielding stocks and go for the lower yielding stocks, that maybe the small caps that haven't moved that much yet, because it's a very interesting market. We still need equity to provide cash flow.
And maybe some companies with a lower yield but a history of raising their dividends slightly.
Yes.
Because that's a good sign of strength when they can do that continuously. Okay, well, you alluded to this. Millennials are going to be using robo-advisors from everything I'm reading, but at some point, and let's just imagine that it's 20 years from now and they've built up $200,000, and all of a sudden the market cracks and goes down 50% in 1 year, and it'd be wonderful if it doesn't happen for at least 20 more years. Do you think those folks that have been doing that all their adult lives will be able to handle those corrections? Do you think they're going to need help, and there have to be people like us in our industry 20 years from now?
Oh, I think they're very definitely going to move up the scale, the food chain, if you will. The whole idea of robo-advising for the millennials is perfect because the millennials like to interact with a computer, but as they start building up their assets, they're going to need a higher level of service. And I see them graduating from robo, automated advice, to generic advice. And then as their lives become even yet more complicated and they have yet more money, they're going to need people like you and I and our guests tonight.
Okay, good. Good answer. Thank you. All right, let's answer a question. Len Kellman of Ardmore says, will the new fiduciary standards apply equally to all investment accounts?
Len, that's a very good question. Right now, no, they won't. The Department of Labor regulations, soon to become law, and maybe by the time this is aired it will be law, affect only retirement assets. That is your IRA, your 401k, your 403b, your Roth, and if you own your own business, maybe your simple plan that you have for yourself and your employees. The financial services industry, however, realizes that it just isn't practical to have two standards, one for retirement assets and one for non-retirement or personal assets. So I think in time the SEC will adopt exactly the same standards, but I think it's going to take a while. Now, how long is a while? Could be anywhere up to maybe 3, 4, maybe even 5 years. I don't know.
And as we air this show, it's up in the air because of the election, and there's a delay in deciding when it'll be implemented, but it's coming.
It's coming.
All right. Well, thank you for that excellent answer, Pat. So if you have a question for us, we're going to show you how to send it in right now.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Okay, we're back ready to go with our special guest, Mark Blair, Certified Financial Planner, Blair Wealth Management. Mark, thanks for being with us tonight.
It's my pleasure.
Great. Okay, well, tell us a little bit about your journey, how you came from studying at Wharton to your present-day situation as a financial planner and an RIA, which has a special category where you have to treat people as with the best rules possible.
Yes. Well, 6 years ago, I decided to go all in with helping people with their financial planning, retirement planning, all the related topics, and to continue to manage money, which, again, the higher net worth people have other things they need to attend to,
Sure.
and so on. I learned the investment business working at an investment counseling firm for a decade. And so that was really good insights into how to manage money effectively. While I was doing that, I also happened, it was kind of circumstantial, to begin studying a branch of philosophy called ontology, the study of the nature of being human. And that's one of the experiences that has affected the way that I can be effective with people. And I didn't really realize that until I got into this business all in. The other thing was when I was at Wharton, I was the student of and then teaching assistant and then colleague of Dr. Chris Mader. And we used the Wharton management game to teach executives and other students about business strategy and finance. And it was amazing how quickly they could grasp those complex topics because they were making decisions and we'd run them through the mainframe and they'd see the results, and it was just very gripping for them. And that is how I learned the power of using games and the whole concept using gaming theory in many aspects of life, but in particular, given what I'm doing now in financial planning and retirement planning, it's a very useful construct.
Thank you.
Well, with those constructs in mind, I'm sure that gives you a situation where you're a little bit different from other providers. Can you explain that, and can you tell us who your ideal client is?
Yes, thank you. I focus on helping people navigate the two what I consider to be the most profound transitions in life. One is entering the workforce where you begin to produce income, which is the mother's milk of wealth production. And then the second is exiting the workforce and entering the later chapters of your life. And in doing so, I've refined my approach so that I help people look at their concerns, their situation, their ambitions, and then really write their story about how they would like things to unfold. And in doing so, there's a sense of ownership and creativity. It's not just numbers. And then after that story's written, that's where all the mechanics of the financial planning comes in, and you look at what are the best moves that they can make to improve their situation. But I find that's a very needed element that doesn't show up in a more traditional financial planning environment. And I'm proud to be a certified financial planning professional. That's the gold standard, as you know. And I think everyone deserves that, just like they deserve the fiduciary standard.
As you're talking about helping people get ready for retirement, people are busy, they have kids, they're worrying about putting them through college. And unfortunately, a lot of times it's pretty late in their lives where they really get focused on the retirement piece for themselves. Talk a little bit about how you help people through that.
Well, when we sit down with people, one of the things that I emphasize is to not be judgmental and self-accusatory. You've done the best that you can and the best that you knew to do in your life, in financial and other arenas. And what I find is important to just help people acknowledge their anxiety, their fears, but when they get grounded in understanding what their situation is, really, sometimes it's better than they imagine. I know people who won't even open statements because they're terrified that they won't have enough money to retire.
Yeah.
But on the other hand, if it's not what you think or would you hope, that doesn't mean you can't design a lifestyle and a way of being that you can live with comfort and dignity, be a member of the community. It's up to you to design what is going to be a satisfying life for you. I think that's really what is going to be meaningful and satisfying to you.
On the other side, I think of some people that shouldn't open their statements every month because they're calling you every day worrying about the markets, right?
Well, that's a very important part. And as you know from your backgrounds, the conversations that we have ongoingly with our clients to help them understand what's happening in the markets and how recurring the corrections are. And some people even view them as healthy for markets and so on. And even with the occasional crash, if you wish, there's a clear upward slope to the markets. And the demographics, the millennial generation being 10 or so million more than the baby boomer generation, would suggest that there'll be a steady flow, actually a growth in the number of consumers. And since consumption is 70% of the economy, that's a really good sign that suggests to me that upward slope will continue.
Well, given that, at Merrill Lynch, we say retirement today is a different beast, and it is, because many people retiring today, their parents had defined benefit plans, whereas people retiring today have defined contribution plans. So clearly they can't retire the way their parents did. So how do you help them through this transition? Because that's the role model they've seen. But that's not what it's like today.
Well, you're right. And again, from that study of ontology, one of the things that an insight that I gleaned was that we inherit some beliefs and we form others as a result of assessments and other things. And then these beliefs, like I have to retire the same way that my parents did, or I'm a bad person, or I didn't do something right, or, fill in the blank, all the negative assessments we have of ourselves. But as you mentioned, that fundamental retirement model, the pension benefit thing, has changed dramatically. And another sea change, really, that's confronting us now is in the world of work and career, those games, as I call them, where with automation and artificial intelligence, the rate of change is accelerating greatly. And so the predictability, it's all changed. And so now we find ourselves in kind of ongoing state of trying to be ready for the next wave of change. So when we're exiting the world of work, we can relax a little bit about that. But you know, I think because of those profound changes, it's okay. You should give yourself permission to challenge that belief and say, you know, do I really need to hold myself to this, or can I invent something that is more contemporary and more appropriate for me? And so that's where we work at on that.
You provided some pretty interesting statistics in preparation here. You mentioned people from 55 to 64 have median retirement savings of $103,000. And you know, these days with a 4% return, $1 million only gives you $40,000 a year. So this was pretty scary information for the average person when I looked at it. So how do you deal with that? How do you get people's attention and say, you have to either work longer, do better, or whatever? I mean, you're the kind of person that likes to not be confrontational, but something has to jolt these people into a reality.
Well, you're right. I don't like to be confrontational in a negative sense, but a big part of being a financial planner is serving up the information in a way that people can understand it, and then I pay special attention to the emotional aspects of it.
Yeah.
Yes, this can be jarring news for people, but again, the notion of being able to design your retirement experience rather than be driven by a belief, which you probably can't meet, at least the median person can't,
Yeah.
that relieves the pressure. Encouraging people to feel the freedom to say, okay, I'm not going to do it like mom and dad, but that's okay. What works for me, given the means that I have, and it can be an iterative process, you know, like, oh, I'd like this, well, let's look. Well, we can't fund that. Okay, well, let's, instead of a condo, maybe we rent an apartment if you're, you know, really strapped.
Yeah.
But as long as you have enough to take care of your safety and food needs and can be in a community, you can have a great life.
Yeah.
It just, you know, may not be the retirement that your folks had, going to the country club or something, but this is what the reality is for you. And that I do impress upon people.
And I've had some clients listen and figure out what was going on and move to a small town in an inexpensive area, and they can live a pretty prosperous, happy, healthy life because they will have enough in that area, and if they try to stay in an expensive area, they won't.
That's a very good strategy for people. And the reason I say that is that, yes, I know several of those municipalities, and always in the back of my mind saying, well, if things don't really go as well as we hope, you know, we could end up there. And the challenge there, from my perspective, is to then build that sense of community that has great gravitational pull for us. A similar point is the people who have vacation homes. We have one in Sarasota. And for many years we figured, well, we'll just pull up stakes eventually and move down there. But we're reconsidering that now, and we're actually going to turn it into an income property. Rent it off during the peak season. It'll probably pay for itself.
Yeah.
And we'll be able to go down and spend at least a couple of weeks down there in the off season, which is when we tend to go down there anyways.
Sure.
So, you know, that's going to go from a cost center to a profit center, or at least a break-even type thing, which will, again, be an investment. And we get to stay here, enjoy the community that we have, and go visit.
Yeah.
Now, in the few minutes we have left, you've heard Charlie and I talk quite a bit about this new Department of Labor reg becoming law. What's your take on that, and how do you think that's going to impact investors' retirement savings?
Well, you know, Pat, I'm encouraged by your comments. You are very confident that it will pass, and given where you work and the resources you have, I'm glad to hear that, because I think the good news of that rule is what you've talked about. Everybody deserves that level of commitment from their advisor to do what's best for a family member, not just try to profit. You know, some people, they have choices and they'll sell certain products or whatever. On the other hand, when they implemented a rule like that in the UK a few years ago, they saw that many advisors left the market, which tells you something. But by the same token, since many investors, smaller investors in particular, deal with and got assistance from albeit perhaps not the best from a cost standpoint, they still got advice. And some of these messages that are so important for people to understand, they got from them. So to the extent that some people won't be served by human beings, maybe the robos will do it, maybe the generic will do it. I don't know about that. But so that's kind of the good news, bad news. But as an RIA, I don't need that law. I think that's the way to deal with people in all my dealings. Mm-hmm. So I do it without the law. But I'm an independent RIA, so that I have absolutely no conflicts of interest.
In the minute or so remaining, it's a tough thing to hook up with clients often enough to keep them, interested and motivated and doing the right thing. Some people think of this as a visit to the dentist. How do you go about making sure people are in touch often enough but don't seem to be bugging them? How do you work that out?
Well, for me, when we're discussing a relationship, one of the things that I impress upon them is that I really want to have access to them on a monthly basis at minimum. It can be more often if they need or want to talk. But kind of a rule of the game, if you wish, of me managing their money is that we talk once a month. And we typically set it up in advance on a recurring basis. And it's an hour long, and I'll provide them with the updates on their portfolio. So each month they get a performance review, if you wish. And I teach them how to understand that. So they don't need me for that, but all that behavioral stuff you're talking about, and these other subliminal messages that are so important to communicate to people, that's just the way I do business. So yes, and then it's ongoing education, a little therapy, facilitation on some of these questions, and an opportunity to bring up some of the questions and concerns that they'll eventually encounter as they get older.
Thank you, Mark Blair. We hope you'll come back again. It's been a fascinating show. Our guest next week is Dr. David Zuzga, CEO of Biodetego, Diagnostics for Cancer. And I guess a big percentage of Americans have to worry about cancer. It should be an informative show. We hope you'll stick with us. As far as we're concerned, your money matters.